Thank you. Welcome to the Q4FY20 earnings call of Dixon Technologies. From the management, we have with us Mr. Atul Lal, CEO, and Mr. Saurabh Gupta, CFO. Over to you, sir, for your opening comments.
Thank you, Dhruv. This is Atul Lal, and we also have with us Saurabh Gupta, CFO. So, good afternoon, ladies and gentlemen. Thanks for joining this call. Before I touch upon our Q4 FY 2020 results, I would like to update you on how we have fared during the lockdown and the latest update in the post-relaxation. So we resumed our operations in all our factories, in all our 9 factories, between 4th of May and 18th of May. This was with limited capacity utilization in May because we had to implement various safety training measures and other guidelines and new standard operating procedures. So we've had a complete business continuity in all our factories and verticals within the permissible norms and regulations. New standard operating procedures have been prepared to ensure safe resumption of operations across all our factories. This is with regard to social distancing, sanitization of premises, buses, temperature checks of all our personnel, availability of the protective wear, and the complete new infrastructure. We're slowly ramping up our capacity at all our factories without any compromises on the safety side. So as we speak, our factories in Tirupati, Noida and Dehradun are completely operational. During these extremely difficult times, we mentioned before our key focus was on cash and to reduce our costs. So we have identified significant cost-saving measures from April onwards, which is to the tune of around 8 to 10 crores a month. A task force has been set up, which is monitoring at a very granular level the implementation of this cost reduction. Our balance sheet is strong, and we closed the year with a strong cash balance of more than 100 crores. We have adequate working capital lines to ensure that even if things worsen, we are fully protected and continue to build our business and capabilities through the extremely difficult and uncertain period. Now, coming to the financial and operational performance of the last quarter, it needs to be contextualized around the unprecedented health and economic crisis triggered by COVID-19, starting from China, with whom we have large relationships, and then globally and within India. So when it started off in January, February, we had supply side issues from China, and there were concerns about the availability of material. And as the first signs of pandemic emerged in India, from second week of March, the India sales slowed down, and it came to a particular absolute halt from March 22nd, 23rd. So we lost almost 10 days of sale in March. Currently, while the lockdown situation has eased to some extent in select markets, we expect the effect of pandemic to last for a few months before the situation reverts to normal. However, with cost rationalization measures undertaken along with the resumption of operations at all factories, and now we have reached a decent level of capacity utilization, we may break even financially or book a marginal loss at EBITDA level in Q1 2021. This is what I wanted to update the house. Now, if we analyze the Q4 FY20 performance, the company's revenue and profitability, it has been, I think, a fairly good performance. It was a very good performance till February, and we were expecting it to be one of our best quarters. But we were hit in the last 10 days of March. And as per our estimates, in this quarter, we lost the revenue of almost 165 crores and the EBITDA of almost 10 crores across all segments. So this is what I wanted to update you on where we are, how we performed during the pandemic, and what is the status at present. Any questions pertaining to this, we most welcome after my opening remarks. Now the financial highlights for the year ended March 31, 2020 on consolidated basis. The consolidated revenues for March quarter was 857 crores, which is almost flat as compared to the same period last year. If we had included this 164 crores of sale loss, the growth would have been around 19%. The consolidated EBITDA for the quarter ended March 31, 2020 was 55.9 crores against 39.4 crores in the same period last year. That's a growth of 42%. Excluding this, again, the EBITDA would have improved by another 10 crores. A significant thing is that the margins, EBITDA margins have improved from 4.6 to 6.5%, which is a significant improvement. This is primarily because of the operating leverage kicking in various verticals, improved sales mix, new and expanded mobile business, value engineering of products, cost efficiencies, and slightly benign commodity prices. So we've seen margin expansion across all our verticals. Consolidated PBT for the quarter ended March 31st, 2020 was 37.3 crores against 24.4 crores, which is a growth of 53%. Consolidated PAT was 27.6 crores against 16.5 crores, which is a growth of 67%. This would have been higher than another 7 crores if we had been able to execute the sales in the last 10 days. We also demonstrated a solid free cash flow generation post-capex of around 91 crores in 1920. This is on account of strong profitability and working capital efficiency, which has resulted in a negative debt of 13.5 crores. There has been a decent reduction in the interest cost also after adjusting for Ind AS. In addition, the strong return ratios maintained. We have an ROE of 26.2% and return on capital employed of 33% at the end of Q4 financial year 20. So as we have been sharing with you, the future also the focus and the three drivers are going to be cash flow generation, money expansion, working capital efficiency, and disciplined capital allocation. So in the operating cycle side, we've had a negative 4 days operating cycle in our business. I've always been sharing that the focus across all our businesses is to achieve a scale that kicks in operating leverage, migrate more and more to our own design solution, focus on backward integration, which gives in which the payback is within 18 to 24 months, more customer acquisition, and deepening of relationship with existing customers to enhance the stickiness. So across all our verticals, we as a team have done well on all these accounts. We have seen that when we meet these objectives, we're able to generate significant operating leverage and become more and more competitive. So also I'm very happy to share with you, this is something very prestigious for our company, our foray into the space of medical electronics. We have signed a memorandum of understanding with Molview. This is for manufacturing of RT-PCR test device. This is for COVID-19. Now this is a disruptive test device, RT-PCR for COVID-19, in which we can conduct the test within 55 minutes of taking of the swab. It has 2 stages. The first stage is on connection of the swab. We remove the nucleic acids from it. And in the second part, on 35 minutes when the swab is shifted onto the chip, it gives the result of positivity or negativity. It is a highly sensitive equipment. It has been approved by ICMR. This is a disruptive technology developed by our principal Molview. We are very proud of getting associated with them. We've got a large order from them. In Dixon's case, we have to upgrade ourselves on our quality systems for medical grade. So we are going to qualify for ISO 13485. And we are also in a learning process of handling the medical grade components. So the team is gearing up for it. The trials are expected to start sometime in July, that is next month. And we should be able to start the commercial production in August. Significant thing also is that there is no capex being made for this particular project. This is going to be done in our Tirupati plant in the DVR and the security surveillance plant, where the capacity utilization is at present low. So we are very excited about this project. This is for the national cause, and this is Dixon's entry into the space of medical electronics. Now coming to specific verticals, starting with consumer electronics, with LED televisions. Our revenues in this quarter were 393 crores as against 323 crores in the same quarter last year. That's a growth of 22%. Operating profits saw a growth of 138%. In this quarter, we generated an operating profit of 9.8 crores against 4.41 crores in the same period last year. We presently have a capacity of 3.6 million, which is the largest capacity in India. I had shared last time that we are increasing our capacity because of a very healthy order book. So we are on way to expanding our capacity to 4.4 million, which has happened within August this year. So this increased capacity means that we will be able to service almost 30% of the Indian requirement. As I had shared in my last call also, that we are doubling our capacity of our TCBA lines and T lines. That's also on the course. So we will be increasing from at present around 1 million to 1.8, 1.9 million. That will also happen within the next quarter. So with this, Dixon will be most vertically integrated, largest capacity LED TV facility in India. We are investing hugely into our R&D also, both in the China labs and India lab. In the new customer acquisition on the TV front, now we have signed up Toshiba, Nokia, and Hisense. We expect to start the production of these brands in July next month. In the month of May, we produced around 1.25 lakh sets, which is around 35% utilization. This month, we should be doing more than 200K sets, which is almost 65% utilization. Coming to lighting, in lighting, it's a small degrowth, a degrowth of almost 16%. So that's 255 crores against 305 crores last year. However, the operating profit grew as compared to last year by 18%. So against 21.6 crores in the same period last year, we have 25.4 crores in Q4. The margins in lighting business have expanded from 7.1% in Q4 18-19 to 10% in Q4 19-20 due to operating leverage, favorable commodity prices, and migration more and more to ODM. So in our last quarter, the ODM business of lighting increased to 94%. So we practically have all the brands in lighting with us, all the major brands. We are the largest OEM in lighting vertical. We have a capacity of almost 20 million bulbs a month, which is 45% of Indian requirement. We have also developed smart LED bulb solutions, battens and downlighters and emergency bulbs. A recent customer acquisition, because we practically have almost all the brands, is Reliance private labels, for which we start supplying to them in August. As I had shared with you in my last call, that we are on the path of capacity expansion for battens and downlighters. So that has already been done in phase 1. The capacity of battens has been increased from 250K to 1.5 million a month, and downlighters has already been increased from 150K to 600K per month. So we've seen that with this kind of volumes, customer relationship, large product portfolio, capacities, ODM strength, we have a great operating leverage and cost competitiveness for the global markets. So we'll start exporting in this fiscal for our anchor customer to large developed markets like US. We also have significant traction from some large retail chains in Europe and US. So we are working towards that. Post the opening up, now we are at 50% capacity utilization. We hope that we will be able, because the order book is increasing, we hope that we will be able to ramp up. This is a labor-intensive business, so the labor availability is a bit of a challenge, but we are working on it. In washing machine home appliances segment, there was a degrowth of 3% 92.5 crores versus 90 crores. It was 92.5 crores in 18-19, which reduced to 90 crores in Q4 19-20. Operating profit, however, increased to 9.9 crores. Operating margin also expanded to 11% against 10.2% in the same period last year. We have 140 odd models and have large portfolio ranging from 6 kgs to 10 kgs in the semi-automatic category with an annual capacity of 1.2 million, which is approximately 27-28% of the Indian requirement. As I had shared with you in last call, we are on way of setting up the top loading factory in Tirupati campus of ours. So that's on course in spite of the pandemic, and we are trying our best, and we are confident that by Q3 we should be able to have trials of top loading. This is annual capacity of almost 6 lakhs, which is again almost 25% of the Indian requirement. This is completely ODM, all platforms right from 6 kgs to 9 kgs with 30 variants. We have already closed the agreement with a large MNC brand for this particular business. Next is mobile phone segment. Overall revenues for quarter 4 were 60 crores against 67 crores in the same period last year. However, operating profit saw a very significant growth of 416%. It increased to 8.5 crores against 1.6 crores in the same period. This is primarily because of a new account acquisition, which has led to this increase. So we have now a capacity of 2 million feature phones per month for our anchor customer, and the production it had touched in February almost 110% of the capacity. The businesses have started post-pandemic, lockdown lifting quite well. The order book is very healthy. However, because of the manpower constraint, we have been able to reach only this month we should go around 70% of our capacity. As I had shared with you that in our other mobile factory where the capacity utilization was slightly low, and we have ventured into set-top boxes for Jio. We have received a large order from Jio for cable set-top boxes to be supplied to Den and Hathway. So the commercial production for that has started. That's an order of almost 500,000 sets. Also for Jio set-top boxes, we have started producing the hybrid set-top box for fiber connectivity in our Tirupati plant. So on mobile, I would like to share with you further what our plans are. You would have read the government's focus on mobile manufacturing, on local manufacturing for domestic and exports, and they have come up with something called a production-linked incentive scheme, which has been announced. In that, they have given a financial incentive linked to manufacturing, linked to investment and turnover, and the total kitty is almost 41,000 crores. The incentive is in the range of 4 to 6%. Now, in this, there is one category for the foreign companies, and there is another category for domestic companies. For the foreign companies, the threshold for investment and incremental sales is much larger, but that incentive is applicable only for the mobile phones above $200. Please appreciate that in India, more than 75% of the market is for phones, smartphones sub 15,000 rupees. And for that, only domestic companies are entitled. They are in the process, they've shared that they're going to be identifying 5 domestic champions who are going to emerge as very, very major players for mobile manufacturing, both for domestic market and exports. So we're going to be very aggressively bidding for this. Our applications will be filed shortly, and this is going to be a significant growth curve for us. So we are already receiving very, very big traction from large global brands for both domestic market and exports. So this is going to be a very significant domain for us for both. And next is security surveillance systems. So there is a 20% degrowth in our share of 50% revenue. This is in JV with a 10% limited. However, the operating profit witnessed a growth. So the operating profit has increased from 1.6 crores to 1.9 crores in Q4 of this business. business is under pressure because this is a discretionary item, and the order book is under pressure. So this facility, this capacity, see, one of the strengths we have at Dixon is the fungibility of the assets. I've always been maintaining the SMT lines which we use for, let's say, mobiles. The same lines can be used for TV or for DVR or for cameras. So this particular capacity is being used for Geo hybrid set-top boxes, and the same capacity is going to be used for RT-PCR medical device. In reverse logistics, and there is a significant turnaround in the business. Revenues have grown by 84%, and also this was a loss-making business, but we have been able to turn it around, and we have generated an operating profit of 43 lakhs in this business. This is a growing business because we have a large customer relationship in LED TV panel repair. So this is what I wanted to share, and thanks for this. And any questions, you're most welcome, please. Me and Saurabh are there.
Thank you very much. Ladies and gentlemen, we will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handset while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. We take the first question from the line of Renubed from IIFL. Please go ahead.
Yeah, hi. Good evening, sir, and congratulations for strong results despite challenging market environment. So as you mentioned in some of your comments, would it be helpful if you can share some more insights in terms of how do you expect the demand outlook for the end brands to pick up? Because somewhere you have mentioned across LED TVs and washing machines are back to 60, 70, 80% utilization levels. But do you perceive any risk to the initially budgeted volumes for the current year based on any likely slowdown in consumption patterns? And accordingly, what would be the kind of growth that one should anticipate or volume numbers that one should anticipate for the current year in these segments?
Renu, you see, at present, it's very difficult to share that how this whole year is going to pan out.
Mm-hmm.
It's very, very difficult. I'll share with you what's happening as of now, and I'll share with you some sense of what we feel how it's going to be.
Correct. In terms of how the ramp up in terms of volume can happen from where we are today.
I'll just share with you.
Sure.
So starting with televisions,
Mm-hmm.
Our anchor customer is having a very large online play.
Yeah.
And we have large customer acquisition. So we were very pleasantly surprised that in the month of May, they were able to sell a very large quantity.
Okay.
Whether there is pent-up demand and that was being filled in, and then it's going to flatten, it's difficult to say. So even the June is going very, very strong. Even the July numbers are looking very, very strong.
Okay.
We need to really wait and watch how it's going to pan out.
Sure. Similar would be the case for washing machine where we have seen some volume slowing from Samsung.
So in washing machines, I can see the slowdown. The May lifting was minimal.
Mm-hmm.
June lifting, normally we do around 70,000-80,000 sets in this month. June order book is around 44,000.
Okay.
So one has to wait and watch how July over September is going to pan out. So the kind of push that I'm seeing in televisions, I'm not seeing similar thing in washing machine. When it comes to lighting, so we opened up the factories only between 10th and 18th of May.
Mm-hmm.
So the present order book in this month, we're going to do, last month we did around 4 million. This month we're going to do around 9 million to 10 million. Normally we do around 15 million. So there is a traction, And I feel that lighting should be slightly better because the product range that we have is a low value item.
Right.
It's going to be slightly better. But whether it's going to be a huge boost, I have no idea. One has to wait and watch it. How do the brands fare?
Sure.
Mobile looks extremely strong because it's a low-end feature phone that we do for Samsung. So this is both for export and domestic market. There's no slowdown. In other factories also, the order book is very good. They've acquired a new customer in LG as a brand.
Okay.
So LG production starts in July, in June only. So I see the mobile business doing well. And also we have a large order book of set-top boxes. In set-top boxes, we added a new customer in Dish TV. So the order book is not an issue. In security surveillance systems, the order book is very bad.
Sure. So second question.
Now, how the numbers are going to pan out, I think it's very difficult for both me and Saurabh to share at this point.
Yeah, good evening, Renu. Saurabh this side. Yeah, so as Mr. Lal mentioned, it's very difficult to give an outlook for this year. But as of now, things have started on a good note, better than what we had thought about it. So May, June, as Mr. Lal mentioned in his opening remarks, that even the first quarter, we are looking like an EBITDA break-even or a marginal loss kind of situation, which according to us is a very good situation considering the entire April or mid of May till mid of May it was completely shut down.
Yeah. So definitely a strong treat on that side. And two other small questions. In terms of given that currency depreciation has been meaningful over the last 6 months and last quarter per se, so what is the kind of impact that we are seeing, and was there any forex impact in the fourth quarter? And second question after this would be in terms of the capex for FY21. What would be the outlook given that most of your capacity expansion plans you mentioned have been on track?
So Renu, with this lockdown happening and so definitely last few weeks of March, there was a significant depreciation in rupee. It went up to as low as 76, and we had, of course, not all of our foreign exchange liabilities hedged because we generally hedge almost 45-50 or between 50 to 60% of our import liabilities hedged. So definitely there is a loss which we took. The loss was somewhere around 4.5 crores. So that's reflected in this number. So our numbers would have been higher by that particular number, and of course the impact of the lockdown for the last 10 days, which Mr. Lal had already mentioned, which was 10 crores of EBITDA. So that is already reflected in the results. Your second question on capex.
Yeah.
So capex intensity, we don't see it reducing this year because we think we are sitting on a big opportunity right now, and we have good cash balance. And so if I just break down the capex, so our majority capex this year will go into the fully automatic top load version, almost 45-50 crores, which is already committed, and we are committed to start the production by Q3 of this financial year. We already have agreements signed up with a very big MNC, so that is committed and that will continue. The second capex was on expansion of capacities in TV, where we were expanding the capacities from 3.6 million to 4.4 million. So that is also in progress because we have a big order book from Xiaomi, and we are adding these 3 new customers, Toshiba, Hisense, and Nokia. So we need to do that. We are committed to do that as well. And then lighting, we foresee that there will be labor issues. So initially we had built an automation kind of a plan in phase wise, and we are continuing to pursue it. In fact, we are accelerating that whole capex on automation so that we are able to so that the dependency on labor reduces further, and we are not impacted by that. The fourth bigger capex that can come will be on account of the PLI scheme, which for a domestic company, there is a commitment of a 200 crore capex over 4 years. The first year capex should be somewhere around 50 odd crores. So that will also we will be doing because that really opens up big opportunities for us, and that will be really very profitable for us. So as far as capex intensity is concerned, it will be high this year. The good part is we have enough cash balance. We have enough, I would say we can always take more debt to pursue our organic growth capex, and we are not slowing down our capex this year. So we will continue to have a capex of around anywhere between 90 to 120 crores.
Okay, that is including PLI capex, 120.
It's including the PLI capex, right?
Yeah. Done. I'll get back in the queue with more questions. Thanks and all the best.
Thank you, Renu.
Thank you. Before we take the next question, I'd like to remind all participants, please limit your question to 2 per participant. You may rejoin the question queue if you have a follow-up. Next one is from the line of Sunita Nair from IDFC. Please go ahead.
Yes, sir. Congratulations on a good set of numbers, sir, in a challenging environment.
Thank you, Sunita.
Wanted to touch upon the margin profile that we saw in lighting. It was fairly strong despite the quarter-end revenue miss which happened because of the lockdown. Now, as we move ahead and it takes time to kind of ramp it back up, what drove this 10% margin? Is it one-off, and will it come back to the normalized rate of something like 7-8%? And my second question was around this medical electronics that you spoke about. How quickly can it scale up? What's the potential of revenues, margin profile, etc.? If you can touch upon that. And lastly, for mobiles as well, by when do you think this benefit of the local manufacturing and production incentive will accrue only after 4-5 years, or is it something that we can start seeing immediately?
So, Bhumika, responding to your first question on the margin profile of lighting. So I won't say it's one-off, but I would say I would like to give a guidance of around 8% on lighting, right? Somewhere between 8 to 8.5%. That's what one estimates. Coming to the second question on PLI, the PLI scheme says, so we have to file for our application before 31st of July.
Okay.
We are confident that we should be one of the domestic champions identified by the government. We're sitting on a sweet spot. What it says is that once you do a capex of 50 crores and you reach a certain threshold turnover, which is 500 crores, which we're very confident of, then you start getting the incentive. And the first year incentive is 6% of your revenue. So this is, if you're able to crack it, then this will start getting reflected from Q2 next fiscal.
Okay.
Third is medical electronics. So we have got the first order for 1,000 quattros. That's four swabs can be tested at one time. And this is just the start of the business. The first order book is of around 30 crore rupees. But I feel that it's going to be large. It's going to take some time, but it's large because there's a huge demand from state governments, from central governments, from private labs. And at present, they've banned exports because there's a huge requirement for upgrading the Indian testing infrastructure, but then for exports also. So please appreciate that this is not only a testing device for COVID-19, for this particular virus. It's for 27 infectious diseases, including tuberculosis. So it's a very disruptive kind of technology. And ICMR has stated in its reports that the sensitivity is ahead of the conventional testing process of RT-PCR. So it's difficult to give numbers, but this is the first order book I'm sharing with you.
I have more questions, sir. I'll come back in the questions. Wishing you all the best.
Thank you. We take the next question from the line of Nitin Arora from Axis Mutual Fund. Please go ahead.
Hi, sir. My first question, when you look at your gross margin, that has moved quite significantly on a year-on-year basis and sequential. If you can tell us what is the reason attributed to this improvement?
So, thanks, Nitin. You see, it's a combination of factors of migrating more and more ODM, let's say in lighting, which gives us an opportunity to value engineer more and more. So that helps in bringing in the operating leverage and margin expansion. Second is also the scale that is bringing in further operating leverage. And third, This is both in lighting as well as television. Where if you see a significant turnaround is in mobile business. This business till a year back was laggard, and we were always struggling to acquire a large anchor brand, which we have been able to do. I think team has done a very fine job in setting up this facility within a record period of 3 to 4 months, and the capacity utilization touched 100%. So that's the reason, and the combination of these three. This margin expansion has happened, please appreciate, in spite of 10 days of no sale and a hit on the account of foreign exchange. So these are the reasons that this is.
So why I'm asking this, because you have a negative inventory sitting out in your P&L, which is almost to the tune of very unexceptionally high, about 68 crores of negative inventory in quarter, and an annual basis of about 53 crores, a change in inventory, which is straight away hitting your gross margin, going into EBITDA in a big way. Normally, we don't see that much change in inventory. That could have benefited you because of the 10-day shutdown. If you can throw some light there, because it's clearly reflecting the EBITDA gross margin getting improved from there. So, if you can throw some light on that.
We didn't get your question. Can you just repeat?
When you look at your P&L, the profit and loss account, you almost have a change in inventory of finished goods of 68 crores.
Okay.
Against the cost of material of 791 crores, which benefits you in terms of your gross margin. You normally, when you see even on an annualized basis, you generally don't run with a 1450 crore of positive change in inventory. It gets added back. Now, when you look at your annualized result or your quarterly result, it's a big number of negative, which is impacting in a very big positive way to your gross profit and your EBITDA. So, and that is primarily because I'm assuming the 10-day shutdown would have not been able could have resulted in this number. So just need some thought of yours. Please reflect coming from here.
Yeah, so definitely there was inventory which was supposed to be, so there was inventory which was lying with us on FG, and there was also raw materials which we had imported which could not be converted to finished goods. So that is the reason why it is reflecting as negative. So I actually didn't
understanding.
Sorry, sir?
What exactly is your question?
No, I'll take it offline with you.
Yeah.
My second question to this medical device, which sir talked about. It's a micro PCR, which is a step down to a RT-PCR, in India, and it's a step down technology right now. So I just want to understand, because we already have in India about 500 devices of micro PCR, and the way testing is going up, obviously we require double of that. Just wanted to understand once, the reagent is more important than the device, the way we look at this business. But in your assumption, India itself, once this COVID goes down and the testing goes down, are there any other opportunity? Where do you see that coming from this this micro PCR?
So as I shared with you, Nitin, that one can test almost 27 infectious diseases on that. Initially, this device was developed for tuberculosis. So this is disruptive in the sense that it is going to be available at all points of care. That's the scalability. So one is of course for COVID. Second is for almost 27 other infectious diseases.
Getting it. Right, sir. I'll come back in the queue for more question. I'll take that question offline. No problem. Thank you.
Thank you, Nitin.
Thank you. We take the next question from the line of Keyur Pandya from ICICI Prudential Life Insurance. Please go ahead.
Hello, gentlemen. The question is on, so as you mentioned it, now we have turned now we have turned net cash company, so cash is more than debt as of March. So, is it right to assume that for this year, say for Q1, we might need some working capital debt? So barring that, there won't be much need of working capital debt for FY21? I mean, how do you see interest cost and debt figure moving, looking at this Q1 disruption and then subsequent quarters of the year?
Yeah. So basically, I will tell you the position currently. So as against negative net debt of 13 odd crores, because we had, of course, a mismatch in cash flows, and we also need to cover our fixed costs for April and May as well. And the business has just started to basically come back to normal utilization levels, and that also not across all the segments. So the debt levels have increased. Debt levels since 31st March till date. So presently the net debt levels is around 50 odd crores. So we have enough working capital lines this year. I would see net debt levels going marginally for next couple of months, and then once the quarter two kicks in ahead of the festive season, then I think so it should keep coming down. But as of now, between 31st March and today, it has increased.
Okay. And so going ahead, will we need working capital debt once things normalize? I mean, looking at our cash generation, I was just asking, so will we need working capital debt going ahead?
Ultimately,
or it will be only project debt?
That is a function of how much earnings I am able to generate. And it's very difficult to give you an exact number of what is the EBITDA outlook would be. So ultimately, it will be a function of earnings and the cash flow generation in the business, which will kind of determine that what will be the working capital debt that is required in the business.
Okay. However, the mode of functioning is going to be absolutely the same, where there would always be a very significant focus on the current assets. So inventory creditors and matching creditors would always be absolutely focused. The capital allocation for the capex investments is going to be again with the same norm of payback within 18 to 24 months. So if the situation doesn't come back to normal, then possibly the limits are going to be drawn. Otherwise, they are not allowed.
Right. Perfect. The second question on washing machine, you mentioned that right now the order book is low and pickup is slow. So one is the negative impact of operating leverage, and I mean the other side, and the contract that we have with Samsung of revising the prices. So whatever the contract we have. So in this context, currency would impact us. So margin would have dual impact of currency as well as the negative operating leverage. And just if you can clarify the new customers which we have added for semi-automatic washing machine, are the terms similar for the repricing?
Yeah. So as you know that in Samsung's case, it's a 6-monthly revision of price.
Right.
The current appreciation, we were hit negatively, which was an impact. However, the other commodity prices were benign, and that's the reason there was a small margin expansion from 10.1% odd to 11%, even in washing machine case, in spite of the volumes. I feel that in this quarter, of course, the margins are going to be significantly impacted. But if the quantity recovers, because the other commodity prices, copper, aluminum, is benign, I feel that we should be able to sustain once we attain the volume of 70,000-80,000 a month of 10 to 11%. That's what my take is. Now, the new customer acquisition that we had in washing machine segment was Voltas. The commercial production of Voltas and also Reliance. So Reliance has acquired certain brands for the private labels, that's Kelvinator and BPL. So we have already started commercial deliveries for these two. As far as the arrangements with them are concerned, in Voltas case, it's a monthly price revision, and also in the case of
Okay. Sir, perfect. Thank you very much and all the best.
Thank you.
Thank you, sir.
Thank you. Next question is from the line of Aditya Bhartia from Investec Capital. Please go ahead.
Hi, good evening, sir. Hi, sir. My first question is on margins. Wherein in fourth quarter we had revenues getting impacted on account of COVID and therefore negative operating leverage going through. But despite that, we have seen fairly strong margins across all segments, whether it's consumer electronics, lighting, home appliances, mobile phones. So what has that been on account of? If there's any one-off over there, and how should we be thinking about segmental level margins once things normalize?
So Aditya, one of the reasons for the margin expansion has of course been the lighting business, where we have delivered a 10% kind of operating profit margin, and that has happened on account of even further migration to our own design solutions. So last quarter it was 90%. We have even gone now to 94% of our revenues coming from our own design solutions. Second, a lot of value engineering work is being done, and scale, of course, is delivering that operating leverage benefits. So lighting is definitely a category where economies of scale and operating leverage benefits are kicking in. Secondly, if you look at the other reason, if you look at our mobile margins, it has jumped to 14%. So mobile, there are two verticals. One is of course our subsidiary company, Peugeot Electronics, where we do mobile phones for other customers apart from Samsung, which is your Gionee, Panasonic, Carbon, and other customers, which continues to be on a basis where we book the entire revenues and we book the entire cost, and the margins were in that vertical or that company were in the range of 2.5 to 2.7%. So they are absolutely in the same levels of 2.5, 2.7 levels in this quarter. Mm-hmm. But what has changed since last quarter or since last year is our ramped up and stabilization of the Samsung feature phone business. So we started in November. November was of course a small loss. December we started to break even. And in the last quarter, it has completely ramped up and stabilized, and we are doing almost a monthly quantity of 2 million. So we are doing the entire range of feature phones for Samsung.
Also, I'll just come in. I'm sorry, Saurabh. Also, the revenue being booked in the case of this new anchor customer business of phones is not including the material cost. It's only the job working capital.
It's on the contribution basis.
As a percentage, the operating profit is significantly higher. One of the important reasons for this is that. And coming back to your question that how do you feel it's going to sustain? So I feel mobile is going to be healthy, right? It's going to be similar range. I feel LED televisions is going to sustain, is going to even possibly expand. I feel that washing machine would be possibly in this quarter under pressure. Next quarter would come back to the same 10-11%. Lighting will not be sustainable at 10. I think so. It's going to be somewhere around 8, something like that.
So just to give you some numbers, almost. So these are the main reasons. The main reason I say both lighting and mobile as a category help us to improve our margins. This quarter.
Yes, specifically, I was interested with the TV vertical, wherein we had a fairly significant negative operating leverage because we had planned for much higher quantities, but despite that managed to deliver 2.5% margin. So is it partly on account of PCBs for AC which have contributed, or is it just the benefit of backward integration that we have started now realizing?
So it's a combination of both. One, the order book is extremely good. And the second is that the backward integration of PCBs with one of our customers, one of our large customers, global customers, they just started. So with the valuations are better. And with the expansion of capacity of PCBs and high utilization, this will keep on improving. So that's the reason, that's what I shared with you. I feel that the margins in television business are improving.
Understood, sir. And so my second question is on labor availability and cost. Do you think that social distancing norms may make it slightly more difficult to operate in an industry like ours? And do you see employee costs and incentives going up in the post-COVID world and the possibility of margins consequently getting impacted?
So it varies vertical to vertical. In lighting, we are in televisions. One, availability of labor in the Tirupati plant is not much of a challenge. However, the costs have increased because of social distancing on the line. The production is impacted slightly, for which we are making significant efforts in automation, but it's going to take some time to recover. So in the interim period, there's going to be an impact.
Mm-hmm.
And similar impact is going to be there in lighting. In fact, even more. In that, the automation exercise will take a longer time. And that's the reason I've said that I feel that margins at 10% will not be sustainable. There's going to be a cost to that. In mobiles, at present, the lines were structured like this, that social distancing was always kind of maintained at that level. However, the labor availability as of now is a big challenge in Noida. So it's going to take some time to recover. So it's a mix of things.
And if the labor cost itself goes up once things normalize, then in segments like mobile phones or even lighting, despite automation happening, can margins materially get impacted? Like lighting you mentioned, but even in mobile phones, do you see that possibility?
So I don't see that much happening in mobile. I don't see that.
Understood, sir. Perfect. That's helpful, sir. Thanks.
Thank you. We take the next question from the line of Dehan Subramaniam from Stage 1 AMC. Please go ahead.
Yeah. Hi, sir. Thanks for taking my question. So first question was on the consumer electronics side. You have already expanded capacity to like 4.8 from like around 1.8 in the last couple of years. So and you're already at like probably 25-30% of the market in India. So just wondering, what is the potential you're seeing here to scale in terms of like the say next 3 to 5 years? Like what percentage of the TV market do you think you can, eventually be making?
So customer acquisition is a continuous exercise. And today we have a very large set of customers who are very, very dominant players in the domestic Indian market. And when we're seeing the trend, that more and more brands, even when they're having their in-house factories or global factories, are looking at outsourcing. And outsourcing not only for manufacturing, they're looking at outsourcing even on our design. So what number we're going to do 3, 4, 5 years down the line, it's slightly difficult to say. But the growth potential of this vertical is I think is extremely positive. And more and more migration to our own design solution, yes, that's going to be the course. So just like today our ODM percentage in television is minuscule. But if you see in lighting, the ODM percentage used to be sub 20% 3 years back, is more than 90% now. So that's what's going to happen. And our vision, and let's hope where we reach, one has to wait and watch and see, that we emerge as a complete solution provider, completely backward integrated, large product portfolio, multiple customers, and televisions also.
Right. No, so the only reason I was asking was because TV as a category is pretty over-penetrated, right, in India. So if you're still seeing sort of potential, basically you're saying that there's still a lot of room for like more customer acquisition, etc. So, and the second question I have is actually on the mobile phone side, like, could you tell me like what are the new customers you have actually acquired in like the last few months, and based on the PLI incentive and everything, what is the scalability potential here, like over the next 2 to 3 years?
So in our existing 2 factories, one of course of Samsung. So we are doing complete quantity of Samsung feature phones, both for domestic market and export. It's more than 2 million a month and largest in India. Now we are about to start the smartphones also for them. On the other portfolio, we have acquired LG as a customer. So LG smartphones are going to start, and then the customers that we acquired is in Focus, which is an in-house brand of Foxconn. So we start manufacturing for them also. We are talking to some very, very large customers, large global customers. At present, I'm not in a position to share more details, but we feel very strongly and very positively on mobile as a vertical, particularly after the announcement of the PLI schemes. Let's wait and watch how it's pan out, but we're definitely going to be focused on this particular vertical a lot.
So you said LG and in-house brand of Foxconn, and which was the third one?
So basically the future customers will be through the PLI scheme, which we are, as Mr. Lal mentioned, we are aggressively working on. There's a lot of traction in that because the incentive is quite significant. So we are talking to some of the global brands who have very strong market share, both India and globally. So we will.
And all this is only smartphone or even featured phones?
This will be smartphones.
Okay. And like in Samsung, are you like already making smartphones for them or only featured phones?
So we are making feature phones, but next 3 weeks time we start smartphones also.
Okay. That's it from my side, sir. Thank you so much.
Thank you. We take the next question from the line of Bhavani Matlani from SBI Mutual Fund. Please go ahead.
Yeah, thank you for the opportunity and congratulations for good performance despite challenging times.
Thank you very much.
So if you can just help me, so I have two questions. One is if you can help me with your market share in individual verticals and maybe especially in lighting, if you can help with the sub verticals and where do you see potential? You mentioned back-end and downlighters. So that's my first question.
So you wanted me to share the market share in lighting business specifically?
No. So across the verticals, what is the change in the market share during the financial year 20 versus financial year 19?
Lighting, we have a market share of almost 30% as far as LED bulb is concerned. In battens, we have a market share of around 12 to 13%, and downlighter is 7 to 8%. So the team in bulbs will continue to maintain between 30 to 35%, and there will be a significant increase in the market share both for battens and downlighters. In televisions, we have done almost 2.1 billion televisions last year against the total Indian requirement of 14 million. So we are somewhere around 15% share. In washing machines, we have done around 850K of semi-automatic washing machines, and the Indian market is around 3.3, 3.4 million. So we are at around 27, 28%. On mobile phones, on the smartphone side, we're very small. But on the feature phone side, the Indian market is around 8 to 9 million a month, and we are at a level of 2 million a month. So that's almost 25%. So that's where we are.
Sure. And the washing machine, your market share is as a percentage of the total washing machine market or the percentage of semi-auto?
Only semi-automatic. The total Indian market is around 7 million, 6.5 to 7 million. Out of that, we have done 850K. So on an overall basis, we are somewhere around 12%. And only for semi-automatic, we are 26, 27%.
Understand. My second question is more like you mentioned that the labor availability is challenging, and it's for some time now that you will have to adhere to the social distancing. And your business, you need to continuously cut costs. And this year you've seen that the productivity will get impacted. So if you can just highlight how soon can you ramp up in the automation front and how much of it can it offset in terms of your productivity loss?
So on the television side, on the lighting side, I think it's going to take almost 8 to 9 months to completely utilize it through the automation process. There is a capex plan made for automating our half part of the assembly line, which will improve the productivity from 32 per man hour at present to almost 55. But that's going to take some time. Some machinery for that is already in transit and should be installed in the next quarter. But the balance we need to order. In the washing machine side, I don't see a significant impact because it's not very, very manpower intensive. In television side, there is an impact, but I think the team is working on small automation. And I think by the mid sometime of Q2, they should be able to utilize the additional cost impact. In mobile, I don't see a significant impact. So the area of concern for me is lighting, which is going to take some time to utilize.
Yeah. Thank you so much. These are my questions.
Thank you. We take the next question from the line of Mr. Dhruv Jain from Ambit Capital. Please go ahead.
Hi, sir. Just wanted to know, sir, the margins with respect to the mobile phones of the Samsung feature phone business, are they sustainable? And a question related to that would be that as you enter the smartphone market, I mean, is it going to be a similar job work sort of structure where you do not take on the P&L and just do job work for them?
No. So as far as the smartphone for our anchor customer is concerned, the methodology of business is going to be the same as feature phone. But when I'm talking about the scale-up of this business, there is not going to be this format. There we are going to book the material cost and the revenues. The margin profile will be significantly lower there as a percentage of sales. Are you getting my answer, Dhruv?
Yeah. All right. So that's it from my side.
Thank you. Next question is from the line of Shimbi Kalkate from HSBC. Please go ahead.
Yeah, hi. It's Shimbi from HSBC. Thanks for the opportunity. But I just want to understand this PLI scheme operationally slightly better. So the way one should see it is that because you have got shortlisted as a domestic champion, that's why you see yourself in a better position to attract customers, or you already have a client who can come directly to you and that's why you want to apply. First, I just want to understand that. And sir, on the PLI scheme, there are two criteria. One is on the investment side and another is on incremental revenue side. So just wondering, is that the incremental revenue that you see that can happen if we get the PLI, if we get shortlisted for the PLI? Will it be more from an export market, or do you see opportunity for the domestic customers switching to you because you have PLI license? So just want to understand operationally that part first.
So first, the discussions are on with our existing customers and some large global customers. Second, this is both for domestic market, but large export also. Third, the criteria for availing the incentive scheme requires two thresholds. One, when you make a capex of 50 crores, and second, in year one, you attain a threshold level of 500 crores or incremental sales over the base period of last year. And then you become eligible for incentive. So we have analyzed this in detail internally, and we feel that for Dixon to achieve those criteria should not be a challenge. Now, the action is that, again, as I shared with you in my opening remarks, 70% of the Indian market is sub $200, and that can be done only with a domestic company. So obviously, it opens up a large opportunity. And domestic companies, there are very few who are eligible to meet this criteria.
So my question really comes from, we know that the large domestic market is sub that limit that.
Sorry, can you be a bit louder? I'm not able to hear you.
Mr. Kalikat, there's a lot of disturbance from your audio, sir. We are unable to hear you. If you can hear us, please use the handset mode while speaking.
Is it better now? Hello?
So there's a lot of disturbance. I'm sorry. Could you just connect from a different line if you can, because we are unable to hear you. Requesting you to please rejoin and you can join the question queue. Thank you very much. Next question is from the line of Anshuman Dev from ICICI Securities. Please go ahead.
Yeah, thanks for the opportunity, sir, and congratulations for a good set of numbers. My question was regarding the mobile segment. So when you say that next Q2 fiscal, we should be eligible for this 6% incentive. That implies that we will be able to do this capex of 50 crore and additional top line of 500 crore by Q2 of next fiscal. So if you can just let me know the revenue outlook of mobile segment in FY21 and 22, that would be great.
Well, I think it's slightly early for me to tell you about the revenue numbers because it's still in conceptualization stage. But on the basis of discussions that we have had, we feel this is in response to the question to Bhumika that how this PLI scheme incentive will be executed and given by the government. As per our plans, we feel that we should be able to get the facility running within this fiscal. Second, we also feel that we should be able to achieve the threshold revenues which are required as per the eligible criteria. So we are confident of start availing that incentive. Now, how the revenues are going to pan out for 21-22 for mobile is slightly early for me to share those numbers.
Right, sir. Thank you. That will be all. That will be all. Thank you.
Thank you.
Thank you. Next question is from the line of Naval Seth from Emkay Global. Please go ahead.
Thanks a lot for the opportunity and congratulations, sir, on good set of numbers. I have three questions. First is on margins. You have elaborated in detail on margins, how it will fare out across the segment. But in your initial remarks, you stated cost savings of 8 to 10 crores per month. So how will that reflect in your margins if across the segments margins are expected to remain stable in FY21?
So Naval, responding to that question, this cost reduction is pertaining to the period of lockdown. This is not going to be on an absolute basis month on month. This was the cost elimination when the production was not there, and also a huge focus on cost for significant reduction in expenses as the production is getting ramped up. So first thing was to convert most of the fixed cost into a variable cost structure. The second is an absolute reduction in fixed cost. So this is going to be a frugal year for us, undoubtedly. But finally, how this number is going to pan out is going to be linked to how the business comes into us this year.
Okay. Sir, second question is on free cash flow. If I remember in the last earnings call, you had stated FCF was close to around 92 odd crores. And if I look at your year-end FCF again, statement is 92 odd crores. So can you throw some insights over here? What has happened on the cash flow in 4Q?
Yeah. So one of the reasons why it has remained same between Q3 and Q4 is our capex intensity has increased. So last Q4 capex is slightly higher than our average quarterly run rate of capex, and that is mainly on account of the fully automatic top load capex. So there are a lot of advances and payments have been done on account of that. As I mentioned, we need to start the production by Q3 of this financial year. So if you look at the capex number, and if you just compare the capex number of 9 months, I think so there has been a significant growth in the last quarter, and that is the reason, despite having good results and the working capital generation also being there both in 9 months as well as 12 months, the free cash flow is same.
Understood. And last question is on TV, where you had added 3 new customers. So can you share what would be their order book initially, I mean, in terms of number of units?
So between the 3 customers that I mentioned, there's going to be almost 60 to 70K a month.
Understood. Thank you and all the best, sir.
Thank you.
Thank you. We take the next question from the line of Balchandra Shinde from Max Life Insurance. Please go ahead.
Good evening, sir. Sir, as we stated that relatively labor constraint is there for us, by when we expect things to normalize and at least on the production side, we'll not have constraint of labors, and we can reach to the particular capacity utilization levels?
So our Tirupati plants are almost normalized. We don't see a challenge there. Our mobile plants are on the way to getting normalized. I feel by July end, it should be normalized. Our washing machine plant is not a challenge now. But lighting, we have 3 plants in Noida and 1 plant in Dehradun. So there, because the labor intensity is high, and also there is a new norm of social distancing, there is an impact there. So one has to wait and watch how soon we will be able to address that issue.
Okay. Because why was I was asking this is like I read an article where it has been stated that to cater pent-up demand and because of all these constraints, most of the brands are preferring right now to import as much to cater to demand. So will we lose that pent-up demand related volumes, or what is your take on that?
In our case, I don't see that happening much. I don't see anybody importing the lighting products. I don't see anybody importing washing machines. I don't see that happening. There might be some tactical imports for some large brands for mobile, but not for us. They're not our customers. So in our case, I don't see that as a challenge.
And the customers which we have added for smartphones especially, will it be for the high-end or relatively low and mid-end smartphones?
So this is for mid to high-end smartphones. This is a complete category.
Okay, mid to high-end. Okay. Thank you. Thank you very much.
Thank you. We take the last question from the line of Pritesh Chheda from Lucky Investment. Please go ahead.
Yeah, sir, I just have one question. On the mobile phone side, the 2 million units per month that we produce, once the LG and the Foxconn and Samsung's smartphone ramp up happen, what kind of volumes do you foresee in these 3-4 clients put together? And does this need the PLI related expansion, or it can happen without PLI expansion at your existing facilities, whatever number you share?
So this is without the PLI linkage.
Okay. And what volumes can it scale up from 2 million per month to?
So between this, now 2 million is for feature phones. The additional volume of the smartphones that I'm looking at is between 0.3 to 0.4 million more.
And so this is Samsung smartphone, right? And then you have the LG business.
So combination of everything, all put together.
Oh, so all put together 2 million will go to 2.3.
Something like that.
Something like that, 2.3, 2.5, whatever. And this includes your Samsung smartphone plus LG business plus whatever you get from Foxconn.
That's it.
Okay. And you, for that, the 2 facilities that you have is sufficient enough.
That's right.
Okay. Thank you very much, sir.
Thank you. Well, ladies and gentlemen, that was the last question for today. I would now like to hand the conference back to the management for their closing comments.
So thanks very much for organizing this call. And in Dixon, we are committed to what we have been sharing with all the stakeholders. These are difficult times, but we feel deeply that as a company and as a sector, we are sitting on an inflection point. However, the thesis of ours remains the same. We are electronics manufacturer. We'll keep on getting into new verticals, touching the same core. We'll keep on building a scale. We'll keep on acquiring customer. And wherever we acquire the bandwidth, we'll keep on migrating to our own design solutions. That's our thesis, and we feel that we have a strong thesis, and that's what we're going to pursue. Thank you so much, everyone.
So thank you, everyone. If any of the questions are unanswered, I am always available. You can call me and I can answer your questions.
Thank you very much. On behalf of Ambit Capital, this concludes this conference. Thank you all for joining. You may now disconnect your line.
Thank you.